China Nuclear Energy Technology just announced a profit. They say they made 117.9 million Hong Kong dollars in profit. That sounds pretty good, right? Investors like to see profits. It gives them confidence in the company's performance. But hold on a minute, there's something else we need to look at. Something crucial that often gets overlooked. It's called free cash flow. This is the real indicator of a company's financial health, and guess what? It's negative, very negative. This is a serious concern. They had a negative free cash flow of 1.4 billion Hong Kong dollars. That's a staggering amount. That's a big red flag. It signals potential trouble ahead. Don't get me wrong, profits are important. They show the company's ability to generate revenue, but they don't tell the whole story. Profits can be manipulated. Numbers can be adjusted to look favorable. Companies can use accounting tricks to make their profits look better than they really are. This can be misleading. That's why we need to look at cash flow. It provides a clearer picture of the company's financial situation. Cash flow is like the lifeblood of a business, essential for its day-to-day operations and long-term survival. It's the money that keeps the lights on, the machines running, and the employees paid. Without adequate cash flow, a company can't sustain its operations or meet its financial obligations. A negative free cash flow indicates that a company is spending more money than it's bringing in, which is a red flag. This situation is not sustainable in the long run and can lead to severe financial distress. So, how can a company report a profit but still have a negative free cash flow? It's a perplexing scenario. There are a few reasons behind this conundrum. One major reason is that a company might be selling a lot of products or services on credit terms. This means they are not receiving immediate payment for those sales, affecting their cash flow. They might have to wait weeks or even months to collect the money owed to them, creating a cash flow gap. Another reason is that a company might be making significant investments in assets like new equipment or factories. These investments require substantial upfront costs, even though they are expected to generate profits in the future, impacting current cash flow. To understand this better, let's talk about two different accounting methods: cash basis and accrual basis. Cash basis accounting is simple. You record revenue when you receive cash, and you record expenses when you pay cash. This method is often used by small businesses and individuals because of its straightforward approach. Accrual basis accounting is more complicated. You record revenue when you earn it, even if you haven't received the cash yet. This method aligns revenue and expenses to the time periods in which they are incurred. And you record expenses when you incur them, even if you haven't paid the cash yet. This provides a more accurate financial picture. Most large companies use accrual basis accounting. It gives a more accurate picture of a company's financial performance over time, reflecting the true financial health of the business. But it also makes it easier for companies to manipulate their profits. They can do things like delay payments to suppliers or accelerate revenue recognition to make their financial statements look better. Understanding these methods is crucial for anyone involved in financial decision-making, as it impacts how financial health is perceived and reported. A red flag. That brings us to the accrual ratio. This ratio measures the difference between a company's reported profits and its cash flow from operations. A high accrual ratio can be a sign that a company is manipulating its earnings. In the case of China Nuclear Energy Technology, their negative free cash flow despite a positive profit is a major warning sign. Their accrual ratio is likely very high. This means that investors need to be very cautious. The company might be in trouble. Invest with your eyes wide open. So what's the lesson here? Don't be fooled by big profits. Always look at a company's cash flow statement. It will tell you the real story about a company's financial health. Pay attention to the accrual ratio. A high accrual ratio can be a sign of trouble. Do your research. Don't just rely on what the company tells you. Read analyst reports, talk to other investors. Investing in the stock market can be risky. But if you do your homework and understand the financials, you can make informed decisions and hopefully make some money.